Hello, welcome to the next episode of Meet the Investor. Joining me today is Kyle McCarthy, Executive Vice President and Private Credit Strategist from PIMCO, the largest fixed income manager in the world, managing $2 trillion in assets. Today, we'll be focusing on a slightly different segment of the private credit market that PIMCO is also focused on, asset-based lending, where they've deployed over $190 billion over the past 10 years. Thank you for joining us today, Kyle.
Pleasure to be here.
If you could please talk to me about yourself and background, and also not just about PIMCO generally, but particularly PIMCO's in fixed income, and when and how this extended to the less traditional areas of the fixed income market.
Yeah, that's great. Well, again, thank you for the invite. Just by way of quick background, I've been at PIMCO for a little over 10 years now. Have always focused on alternative credit. And internally, I'm a private credit specialist working with our client base all over the Asia Pacific region. So I have a lot of discussions more recently on the growth of private credit and how clients are thinking about allocating more broadly beyond just corporate direct lending into areas like asset-based lending. It's an exciting area for us at PIMCO. It really leverages our expertise and history within not only fixed income, but of course as credit investors. The way we think about kind of the asset-backed or even the private credit markets more broadly is it's private fixed income, if you will. So very similar types of credits, just in kind of different packaging. So we have many decades of experience in the area. It's been from a business perspective, one of high growth for us. So it's quite exciting. And as we'll talk more about today, a lot of investors are very interested in the space and interested in learning more. So looking forward to unpacking it further.
Great, thanks. So we're deep diving today into asset-based lending. Could you tell me a little bit about what that is?
Yeah, sure. So, as you think about asset-based lending, it's really about financing different pockets of the real economy. Typically, asset-based lending refers to pools of loans, leases, mortgages. So very different from a single bilateral loan, which you would typically find, say, in the corporate space or the commercial real estate space. And really, the definition of asset-based lending refers to anything outside of corporate and or property or real estate. So what does that leave? There's really three main subcategories as we think about it. You have consumer-oriented credit. You have mortgage-related, so single-family mortgage credit. And you have other forms of non-consumer-oriented credit, things like transportation finance, equipment leasing. I'm sure we'll get into more details of all of those as we go along. But big picture, that's how to think about it. These areas are, again, because they're a bit more pooled, very data intensive. And so we leverage a lot of our analytical kind of capabilities and expertise in order to underwrite and to source. And one of the key benefits of the space is that it tends to be very diversifying because, again, it falls outside of property and corporate-related exposures. It gives clients a different flavor of credit for their portfolios.
So does PIMCO originate these loans directly, or do they buy them off the banks that are originating the loans? And whilst you're talking about that, why does this opportunity exist today?
Yeah, it's two great questions. So if I can start with the second question, so kind of why does it exist today? I would say high level, very similar theme to what you've seen across private credit more broadly, which is this debanking or disintermediation theme within the banking sector. And the quick history is going back to the global financial crisis. You had obviously a lot of distress, a lot of interconnectedness in the banking system, lack of or inadequate levels of reserves and capital requirements across the board. Regulators stepped in and basically completely changed the game. And so now banks are under a lot of pressure to be more capital intensive, basically, and have to hold more reserves, more capital against their portfolios, which means that many of them are shifting to more of a fee revenue based approach or more of a capital light approach. So, smaller balance sheets and being very mindful of the capital charges that are now being forced upon them. That means that they've stepped back from a lot of traditional lending practices. And so again, in terms of smaller middle market corporate direct lending, that has been one area of significant growth that the banks have stepped back from. Similar theme within the asset-based lending space. So again, anything consumer credit related, anything non-consumer, mortgage related exposures. banks are continuing to originate in some cases, but are looking to originate and sell as opposed to originate and hold. And so that's what's creating the opportunity. And again, it's been structural for some time. We began participating in this space, I would say, back in 2013, 2014, so a little over 10 years ago. But the trend has continued to ramp up and is accelerating in a lot of ways. And so again, it's this theme of kind of bank retrenchment or banks retreating that is allowing private investors to step in and basically take advantage of investing in these credit assets and then earning, attractive income, attractive yields, which is really the key objective, right, in terms of private credit. So that's the quick history. And again, it's a trend that we think is going to continue. I think the regulatory pressures are here to stay. And while there will be tweaks, here and there on the margin, for the most part, regulators have gotten it right, and we've seen the banking system become much safer. And so again, private credit in general, asset-based lending included, here to stay. In terms of the first question on origination, it's a great one and a question we get all the time in terms of how do you think about originating within the space. First off, we underwrite everything in-house at PIMCO. So whether it's originated directly or as a secondary opportunity or a secondary purchase,
buying off the banks, that is. Secondary.
Yeah, that's right. So secondary would be buying from someone else, whether that's a bank or a non-bank originator. In either case, we're underwriting in detail, down to the loan level for everything we source. I would say there are two main avenues to your point, right? So you have direct origination in some cases. So like a good example would fall into the non-consumer bucket, which would be aviation finance, where that's a space where we're originating directly. So basically we own the aircraft, we are leasing them out directly to an airline and then collecting contractual lease payments. Secondary example would be, say, a mortgage pool or a lot of the consumer related credit. PIMCO is not a bank. We don't have a branch network. We don't have direct relationships with end consumers that we're underwriting on an individual basis. But we will let a bank or a non-bank specialty finance player originate those, kind of pool those together and into a certain aggregate to a certain size or scale that makes sense, and then acquire that pool or purchase that pool from them on the secondary market. So it's a very different approach from traditional private credit, right? As you think about middle market direct lending, it's all about directly originating a bilateral loan to a private equity sponsor and lending to them with a single loan. Here, again, there's multiple avenues, different channels you're sourcing, in some cases direct, in other cases, from a bank or a non-bank originator.
So we'll go into the subcategories, I guess, of consumer, non-consumer in a second. But just touching on the different types of private credit you've been talking about there, between lending to a corporate via private equity sponsor, where that corporate might have $200 million of profit a year, for example, versus lending to, as one example, a consumer who is taking money out for their student loan. You talked about pools and so on. Can you just go into the structure of those loans? They seem very different types of loan and almost very different risk profiles as well.
Yeah, that's right. So, you're right. In short, private corporate direct lending is focused on the middle market. Everyone's definitions, kind of vary and range a little bit, but call it anywhere from, as low as 20 or, 50 million EBITDA upwards of 100 plus, even as high as 200 million type EBITDA. But again, these are still relatively levered exposures, right? So most loans are going to be 5 to 6 times debt to EBITDA. So there's still relatively levered corporations. Think of it similar to the syndicated leverage loan or the bank loan market is kind of the main area of competition. The loans are very, very similar. So think from a credit quality perspective, usually around single B is kind of about the general credit quality of most private middle market direct lending loans. So that just kind of use that as a benchmark, kind of a base case, right, in terms of how we think about anything else on the private side. Within the consumer universe, or really anything on the asset-based side, just like any other form of credit, you're going to have a range of credit quality, right? So you have prime-based consumers, or those with very high credit scores that have low debt to income or low payment to income ratios, high income bracket. That tends to be the area that PIMCO focuses on. Probably no surprise, or we're very conservative lenders. But of course, there's subprime borrowers as well. Now that's a much smaller component of the market overall, but that would be the lower quality end of the spectrum. And of course, there's a price for everything, and sometimes that space can be interesting as well, as long as you're underwriting very, very conservatively. But in general, because of the fact that these are pooled exposures, and I use the example of, say, $100 million worth of mortgages could include hundreds of underlying homeowners, right? Or hundreds of underlying borrowers. So there's an implicit or an implied diversification component there already. In addition to the fact that these are relatively smaller balanced loans, right? This isn't a single $500 million or $1 billion corporate direct lending loan to a single borrower where you're taking, decent amount of concentration risk with that one borrower. Here you have potentially hundreds, right? So you do have this implicit diversification within the pooled exposures that I think is quite unique to the asset-based lending space. But you're still spot on, right? You have to do your credit work. And again, back to my point earlier on data and analytics, it's so critical within the space to be doing scenario analyses, stress testing, understanding the credit quality of the underlying pool of borrowers, and making sure that risk is priced, accordingly.
So let's break down the different areas of asset-based lending. You touched on consumer, finance, non-consumer, and mortgages. Starting with consumer, what are the different segments there, and what collateral would there be to take in consumer finance?
Yeah, great question. So on the consumer, there's a couple of subcategories. And some of these, will draw parallels to the asset-backed security market on the public side as well, right? So some of the big ones are auto loans, credit card, student loans, and personal loans, I would say, are kind of the big four within the consumer space. And then while we consider mortgage a separate category, because again, the underwriting is very different, you've got a home as hard collateral there, the end borrower is still the consumer as well. So just kind of a quick sidebar, but it's still kind of consumer oriented. So you're right. Within that space, there are examples where you actually have hard collateral that are securing the loans, right? Like auto is a great example. And of course, on the mortgage side, right, as I mentioned, you have a house or a home. But in other forms, it is a form of unsecured lending. So again, it goes back to having very conservative underwriting, right? So for a credit card or a student loan, for example, there isn't necessarily a hard asset. On the student loan side, I kind of joke that at least there's a diploma, right? There's something physical that you can point to. But still, you're underwriting to, the health of the consumer, the job market, ultimately what type of job that student will get over time and their ability to repay. In that space specifically, there's other ways that you can enhance the credit profile. And we do that, especially when you're underwriting to students, because you say, what type of credit history could a student possibly have? Is these pools tend to require a parent or guardian guarantee as well. So you're not necessarily underwriting or taking a flyer, let's say, on a student. We have no idea what the job market's going to look like in a couple of years, but you can point to a parent or guardian who has a job, has an income profile, has a FICO score or credit score, as we call it in the U.S., has a debt to income ratio, right? You can do a full underwrite still and get quite comfortable with the credit overall. In addition to the fact that, again, there's that kind of implicit diversification that I mentioned earlier. The other point I would just say very quickly is that what's also a bit unique about the space is that we underwrite on a loss-adjusted basis. So unlike a corporate loan where, again, you're earning a coupon or a risk premium, as we call it, that should compensate you for taking the risk of default, here you actually build in a default assumption for unsecured consumer lending. So, for example, we underwrite a pool, $100 million of student loans. We may assume that over the life of say 4 to 5 years for this deal, that you may have 2 to 3 percentage points of defaults kind of per annum, which sums up to, call it 8 to 10 over the full life of a deal. But again, very similar levels to what you see on the corporate side, right? Historical defaults within the bank loan market are 3, 4, or 5%, depending on which kind of market environment you're in. So it's very similar in terms of credit risk. But again, in terms of underwriting, it's pretty unique in that you're actually building in that assumption going in, which is why the price you pay, how conservative your underwriting is so critical.
So moving on to non-consumer, you mentioned aviation finance, I guess would fit in the non-consumer bucket. Some interesting areas here. Could you talk a little bit about those different categories within the non-consumer finance section?
Yeah, the non-consumer subcategory is a pretty fascinating one, and frankly, we need a better name for it other than just non-consumer. It's more of a kind of a miscellaneous or catch-all for kind of anything else that falls into the asset-based lending or asset-based finance bucket. Transportation finance is a big one, right? So aviation finance or aircraft leasing would fall into that category. Very simply put, and I kind of described this very briefly earlier, but you have an airplane that you're then leasing out to an airline that has a lease attached to it, and so you're earning contractual cash flows back. And it's a great example of hard asset-based lending, because if there was a credit issue or if that airline were to default, you take ownership or repossess the aircraft, the airplane, and release it to someone else. And in a market like we're in today, where there's a lot of demand for aircraft and very limited supply, turnaround time can literally be weeks, if not, kind of a month tops for something like that. So not a lot of lost lease time, which is great. But again, good example of kind of hard asset-backed lending. Outside of aviation finance, you've got equipment leasing in there as well. So think, construction equipment. So anything from backhoes to bulldozers to cranes. Sometimes they're owned, sometimes they're leased, and there are a lot of specialty finance companies out there that focus on leasing that type of equipment. Again, similar, right? You've got a hard asset earning kind of contractual cash flows back. There's other types of credit that fall into this category as well. Royalty streams would also fall here. So whether it's drug or pharmaceutical royalties, music royalties, another common investment universe as well, becoming bigger and bigger by the day. Fascinating space, because you're basically present valuing future revenue associated with a music catalog.
So would that be buying the Beatles back catalog, or?
Yeah, essentially, right? Like name your artist, and you're essentially paying the present value for what you think in perpetuity. The cash flows will deliver over time, and then you become the owner of that royalty. And anytime a song is played on the radio, on Spotify, in a movie, in a commercial, on TV, in a video game, you name it. There's all kinds of mediums. You basically are collecting the royalty payment. Very uncorrelated, obviously. So, that's part of the reason this whole non-consumer bucket, it really applies to everything within this non-consumer bucket, but it tends to be very low beta, low correlations, adds a lot of diversification, and very interesting areas as well. Last but not least, there's some other, sub-asset classes too, on the insurance side, life settlement portfolios or longevity portfolios would fall in here as well. Litigation finance, again, all fascinating areas. We could probably spend a whole nother podcast just talking about one or two of these. But this bucket in general, very heterogeneous, very, very much broad and diversified. And again, from a portfolio construction perspective, very additive to an overall fund mandate that's diversifying.
The third category was mortgages, and not to ask a scary question, but I think everyone's got PTSD from pooled mortgages being sold on to non-banks and where that all ends up. Why should that not cause further PTSD for investors?
Yeah. No, it's a great point. And in short, the market today couldn't be more different from, the issues that led up to the global financial crisis. The core issue back in, call it from 2005 to 2008, was that there was a lot of very poor lending practices that were going on. There was credit extended to, not credit-worthy borrowers, and that obviously created a massive asset bubble. You had, not just to blame the borrowers, right? But again, you had financial institutions that were lending at very aggressive terms. So again, it wasn't uncommon to see mortgages at 100% LTVs, even negative amortization. So, no interest payment. The interest is then added to the balance of the loan. And there was very little to no underwriting being done in terms of their ability to repay. I'm sure we all, again, can think back to the ninja loans, right? The no income, no job or assets. Again, it was prevalent, right? So it was a subprime lending issue that was then magnified by too much leverage within the system, and again, a banking system that was also too interconnected, taking too much prop risk with not enough or sufficient collateral or reserves. The good news is all of that's behind us. So once regulators stepped in, They fixed a lot of this. It is very difficult to get a mortgage within the U.S. Just to kind of give you a sense, the subprime market is gone. So the only borrowers that can really get financing today, you have to be a prime borrower. You have to have a pretty clean, track record, a pretty clean credit score. There's very detailed underwriting that is taking place. Again, the big change was that you have to prove ability to repay, which you never had to do earlier, believe it or not. Shocking. Not rocket science, but now you have to. And again, the stress testing is also a big component now, where every deal that's being done is being run through a model that basically says, what if the global financial crisis happens again and house prices were to decline 20, 25, 30%, what happens? And so, lenders are also preparing for, kind of that type of situation. So having said all that, again, in short, the regulatory environment has changed such that the type of lending that happens today is actually safer than it's ever been. And in many ways, we actually think that mortgage lending is safer than the corporate lending that we're seeing take place. Again, low LTVs, a lot of equity down payments being placed. And then you've got really strong fundamentals. The fact of the matter is the U.S. has been underbuilding houses for a very, very long time. Estimates range, but call it somewhere between 5 and 6 million of additional houses that are required to kind of balance out the equation. And in the meantime, because of that undersupply, it's putting a floor on house prices. And even though there's low inventory, low supply, it's keeping house prices elevated, which means that they're a great asset to lend against because of that stability in price. And I'm sure we can talk more about this, but again, the U.S. consumer has also been very, very resilient and is in a great place from a balance sheet perspective. And so we like them as a borrower as well, in addition to the stability of the collateral.
So clearly, if you're paying attention, interest rates have gone up for a period of time now. A lot of post-pandemic savings have been eroded. Lending to a consumer now with rates at these levels, albeit forecast to come down a little bit, feels that we might be going into a weakening consumer in the next year or two. How does PIMCO feel about that, particularly when it comes to this sort of asset class?
We spend a lot of time debating this internally, and it's a little bit interconnected with the mortgage story that we just heard as well. One of the really unique aspects of the U.S. mortgage market is that it's a 30-year fixed rate product. So if you're looking to get a loan to buy a home, you can lock in basically interest rates for 30 years. And a lot of borrowers did over the past few years and or refinanced their current mortgage into a lower rate when basically rates hit rock bottom during COVID. That's also when you saw house prices kind of shoot up. But it means that most U.S. consumers who are homeowners, and again, usually the higher quality end of the spectrum, have very, very low, call it 3%-ish like fixed mortgages that are kind of unaffected by, what interest rates do. So in a lot of ways, the U.S. consumer has been shielded by the Fed hiking cycle, which makes the U.S. really unique relative to a lot of other markets. Obviously here in Australia and in Europe, tend to be a little bit more floating rate based. So the transmission mechanism, if you will, from central bank policy to end consumer to slow things down is much more effective in a floating rate market. In the U.S., again, most consumers were largely shielded, right? If I have a 30-year fixed rate mortgage at 3% and the Fed goes to 5, 7, they could go to 10, I'll just sit where I am in my current house and be very happy with my 3% mortgage. And in addition, all my savings are now earning much higher floating rates. So in some ways, the U.S. consumer is even better off with rates higher. And I think that's why they've been so resilient. And you've seen it in the GDP figures, right? I mean, we've been running at about 3% GDP in the U.S., which is about a full percentage point above what economists estimate is potential GDP growth, right? Or what base case GDP growth should be, around 2%. And a lot of that's consumption driven, right? Because again, they're relatively resilient. So having said all that, though, again, there's a bifurcation that we're seeing take place. So all of that applies to more of the higher quality prime type borrowers. Again, mostly homeowners. Subprime borrowers, though, tend to feel the pinch a bit more from inflation. And from the slight slowdown we're seeing in job growth, and that's where you're seeing delinquencies start to rise, where we're seeing charge-off rates increase, whether it's credit card or auto. So definitely seeing a bit of a bifurcation. So again, it goes back to credit quality, right? And make sure you're getting paid and compensated appropriately for the risk you're taking, but also why we're skewing much more, just to be very clear, towards the prime, higher quality end of the spectrum. We don't have any subprime exposure currently.
So you mentioned risk return there. You've covered a lot of the credit segment. Can you maybe give us an idea of the different risk return profiles across some of these segments that you've talked about?
Yeah, so happy to. So from a yield perspective, I would say the asset-based lending space in general, and kind of equating this more towards a floating rate market, and maybe we can circle back on this point because not all asset-based lending is actually floating rate. But just to kind of speak in consistent terms, general yields we're seeing is kind of a, call it SOFR or base rate in the US plus 300 to 500 type credit spread. So again, with the base rate around 4 to 5% today, you're adding 3 to 5 points on top of that, and you're basically getting to high single digit type unlevered yields, which is pretty attractive unlevered cash flow. And again, the key benefit here, just like any private credit investor, is looking for consistent income, right? Stable income generation. That's exactly what this market is designed to deliver. These assets tend to also finance quite efficiently. Now, I'm not suggesting we use a ton of leverage, right? But even at these current levels, with very prudent, modest amounts, you can turn a high single digits yield into, low double digits, even mid-teens in some cases, right? So back to aviation leasing that I mentioned earlier, lease rates there are about 7-8% unlevered. The financing we've been able to lock in with our counterparties takes that to about a 15% all-in yield. And again, hard asset backing, relatively stable collateral in high demand, easy to repurpose in a credit event. We think that that's really, really strong risk return. So in summary, where we stand today, call it high single digits unlevered, ability to get to double digits with financing. Yes, rates are likely to come down a bit over the next couple of years. We're very mindful of that. But I think it's important to note that, again, we're going a little bit lower, maybe by a point, 2 points at the most, not going back to zero. So it's not like we're returning to, most of the 2010s or during COVID again. Rates are still going to remain elevated, and that is going to be a benefit to credit investors.
Kyle, that was a fantastic journey across the lending and private credit investment space. Thank you for your time today.
Happy to. Thank you.